Okay, in the questions that we've looked at so far, the questions have told us the trading profit. So for example, it tells us in this question the trading profits were 13,000. Here it tells us the trading profits were 120 and at a loss, and it gives us the other income as well in all of these. So for example, trade 1 made a profit of so much, trade 2 made a loss. So to get the trade in profits in these questions, you didn't have any working to do, it was given to you. Now unfortunately, it's not always going to be that easy, and whilst our corporation tax computation is still going to be the same, we're going to have to do a working to figure out this guy here, because it's going to be more complicated than just what it told us so far. But everything is still the same, so we'll have working to do for this, but everything then is the same. We add any case 3, case 4, case 5, schedule D, all these schedule D items cases get added together to give total income. They're regrossed, the chargeable gains are grossed, added to give your total profits and your taxable profits. And then of course we just tax that at the different percentages. So the trading and chargeable gains get taxed at 12.5, the pass income at 25. So that's a typical corporation tax computation, but now we're going to have to do working. And for example, in the book, the example that is here on page 209 is a more detailed question. So it gives you the year end is 30th of September 2016. So that'll be the basis period for the tax year 2016. And it gives us its sales less all these expenses, and it adds other income in there, and it gives us a profit before tax. So in accounting terms, that's the profit before tax. But we can't use that figure as the case 1 profit because it contains things that aren't trading income. For example, if it contains anything that's case 3, 4, 5, we have to show them separate. So any income, and normally where we see them is in the question in other income. If I go to note, so it tells us this is other income. If we look in there in this note H, dividend received from our resident company, okay, that's non-trading income. That shouldn't be included as trading income, so that needs to be deducted. And gain on disposal of building, that's a chargeable gain, that shouldn't be included either. That's trading income, so we have to take them out. So our profits, our chargeable profits, shouldn't include that. And also in rent and rates in the expenses, we've got rent received. That needs to be deducted as well. So we have to take any non-income away from the profit before tax. And then we look at our expenses and we say, well, okay, maybe all of these aren't allowable. So, and I'll run through them now. So the standard working is like this. It's kind of our net profit. It's going to be longer though, but it's start off with your net profit per the accounts. And in this example, the net profit per the accounts would be 437,700. So we just enter that in. And then we take away non-trading income. And then we add disallowable expenses. And that gives us the adjusted trading profits. So you'd have to add lines as you go through this. But the non-trading income, you look at the question. You see, okay, where is the non-trading income? And there is definitely another income. And in this question, rent and rates includes rent received, which is rental income. So when getting that profit, we added in any income received, so we're going to deduct it now because it's non-trading. So we only want to include the trading income. So deduct the rent received. So non-trading income then suddenly becomes maybe 2 lines. We take away the rent received. And then what else is in other income? If we go down to it, sorry for scrolling, our other income is here, and if it's trading we don't need to take it away, but so dividend received would be trading. Bad debt recovered, sorry, not dividend received, discount received. If you received a discount from a supplier, that would be trading income, so you'd ignore that, you wouldn't need to do anything. But for things like dividends received, interest received, rent received, all those things we tax separately as case 3, case 4, case 5. in the tax computation, they need to be deducted. So here, dividend received from our resident companies, not trading. Gain on disposal of building, not trading. So the total of them is the 100,750, and that will get taken away. Then to that we add disallowable expenses, and when we do that we get our trading profits, and from our trading profits we take capital allowances, and that gives us case 1. So this guy, the disallowable expenses, there could be 10-12 add backs in that we have to add back. And that would be an average figure per question, I'd say 8 to 10. So if we look at the question, and what we're looking for here are within these expenses, and maybe in the cost of sales as well, anything that's deducted, are there any of these expenses which are not allowable as deductions? And if they're not allowable, we have to add them back or reverse them. And the rules for them are given further up. So this is on page 209, but page 203 starts off with the rules. So it says we start off the profit before tax, or the net profit. And we adjust for income, non-trading income, and then we take away non-trading income, add any expenses. And these are the things to look out for. Capital items, so anything to do with profit or loss of a sale of an item. Depreciation, it has it here actually, capital items. We look for these things. So depreciation, profits or losses on disposals, so if it was a profit, you deduct it. If it was a loss, you'd add it back. Capital items including repair, so what we mean by that would be purchase of a laptop or a computer. Shouldn't be repairs, or improvements to buildings shouldn't have been repairs, you'd add them back. Any assets purchased, and professional fees on the purchase and sale of capital assets, so accounting fees, purchase of building, planning permission fees, solicitors fees, anything to do with the purchase of a building or an asset. So they're capital expenditure. Any of those that we find, we add back. Any expenses not relating to the trade, so any expenses related to rental income are not allowed. We don't need to add back anything for salaries for directors, so any private expense of an employee or a director of the company will be taxed under the BIK, the benefit in kind rules. So we don't need to add anything back for salaries and expenses, and you haven't done the income tax yet, so it's not something that you did before. Then there are some things which are always added back. And these are things like parking fines, speeding tickets, clamping fees. Now, toll fees are okay because they're a charge. They're not a penalty for speeding or clamping. Parking fees would be fine. If you have to go somewhere and pay fees for parking, that's fine. So are toll fees. But anything to do where you broke the law is not allowed. And I'll go back to lease costs in a second. General provisions, always. So an increase in a provision would be an expense. You add it back. A deduction gets taken away. There's rules there for political donations. Never allowed. Always add it back. Okay, patent royalties always added back, allowed as a charge. We won't meet any charges. And interest and penalties on late payment of tax, not allowed. So lease costs are in the book that you'll receive, but they're explained here as well. So due to environmental concerns, expenses relation to cars, running expenses, sometimes you're not allowed to get all of them as an expense, or you're not allowed to deduct them for tax purposes. So whatever the charges are, you have to multiply them by this formula and add back whatever you get. So it depends on the category of the car, And if we just look at example 1, so lease charges are 5,000, so a portion of those are going to be added back. And it's category A, B and C, so the limit is 24,000, and you've got your tax reference material. And there's category A, B and C, and there's the 24,000, so you'll be bringing the tax reference material to the exam. So the lease charge is by the list price minus the amount, so 30 minus 24 over 30. And 1,000 gets added back. There's a different rule if the lease charge is less, but we won't meet that. So it'll always be in excess. So where the list price is in excess of 24, so for D&D cars, so category D&D, so it'll either tell you the category or it'll tell you the emissions, and it'll give you here the 24 and the 12. So it's the same thing, it's always the same calculation in that lease charges by the list price minus whatever the limit is over the list price. So that's the complicated bit on lease charges. So you have to restrict some of the lease charges, and you can always assume that you'll get the list price of the car above the limit, 24 or 12, whatever it is. So if we go back and look then at the question, I talked a bit like an Australian there, didn't I, with the question? But anyway, raising my voice at the end of the sentence. So where are we? We have added back, taken away the non-trading income. Now we're going to add any disallowable expenses. So we're looking for things that were in that list that we looked at a minute ago. So the first thing is, all the questions are going to give you a list of expenses, and normally there'll be notes and then we go down through the notes. But before you go down through the notes, you just look at the ones without notes. So we've got wages and depreciation here, and then we've got loss on disposal of non-current assets. So they're the three things, so just do them first. Wages, on the face of it, that's okay. If we're not given any more information, that's fine, we don't need to add back anything. Depreciation, that's a capital item, remember, so that gets added back, so we add back depreciation. And then the other one was loss on disposal of the non-current asset, and that's a capital item, so anything to do with sale of an asset, and that's the same as any other expense here, it gets added back, so 3,000. Then we look at the rest, which are the notes. So we just take a look. Rent and rates. Rent and rates paid, fine, it's an expense. And then rent received, we've already deducted that. Motor expenses. So these are all expenses for the managing director's car. Now a bit confusing here. I would have nearly thought it starts there and that's 14,000, and then, but these are the expenses here. So it starts on lease expenses. 14,000, some of that is going to be added back. Petrol, insurance, tax, repairs, running, staff miles. So, okay, the ones that jump out here are lease expenses and parking fines. They always, and clamping fees. So anything with fines and fees gets added back. So that's the easy one. And they were for 1,200. And then with the lease expenses. And it tells us, it must tell us somewhere what type of car. So if it was a BMW car, it was 48,000 and its emissions are 170. So we go to our tax reference material. 170 is here. So we got our 12,000 limit. So it's your lease expenses. So our lease expenses were 14,000, weren't they? 14,000 by the list price of the car. So the original market value or list price was 48,000. 48,000 minus the limit of 12, which we get from the tax reference material for category, whatever, it was 170 grams, wasn't it? So it was category DE, 12,000, over the list price, over 48,000 again. So that works out at 10,500. So our total add backs for that are 11,700, but it's better to do them line by line, not to bother with adding them together. Just do each item that you add back. Insert a few more lines here. So then, I'm looking at the wrong thing. That's everything on motor expenses. Subs. Chamber of Commerce, fine, it's business related. Golf club subscriptions for MD, that's fine, it's an expense, but it's for an employee, the managing director, and he'll be BIK'd or she'll be BIK'd on that, so it doesn't get added back. It's an allowable expense. Professional fees, so we add back anything here that's capital related or to do with another trade. So disposal of storage facility and rental property. Rental property is case 5, it's a different type, it's non-trading income, and that's a capital item. So legal fees. And the two then get added back, and they are 7250 and 3,200. Try and get through this now. Political donations never allowed. Donations to charity, they're okay once they're over 250. So if you're not sure, you just need to go back up to the pages that look at this. Page 205. And here's the rules for donations. So 250. $4,250. Next, please. Bad debts. We're only interested in an increase or a decrease in a general bad debt provision. So if you don't see a general bad debt provision, you don't need to do it. You can ignore it. So that's bad debts written off, bad debts recovered, increase in specific provision. They're all okay. We only need to do something for a general bad debt provision or a general provision of any type. Interest, trade purposes, fine. Late payment of VAT, never allowed. And rental properties, case 5 is non-trading. So those two get it back, 3,250 and 50,000. And I think that's it, is it? We'll see if I've forgotten anything anyway. We'll see. So they get added up. And then we just go all of that. 394,600. So that's the adjusted trading profits. And then from that, we take our TL allowances, or even capital allowances, might be better. The capital allowances get deducted to get case 1. So if we look at the question, there's a work into that for this, unfortunately. Some questions might tell you. So here, equipment, van and car, right? And there's, we purchased some, there's whatever the purchase year. And during the year we disposed of a van and we acquired these. So you nearly always do the disposal first, just in case there's a balancing charge that would, you can reduce the cost of a replacement item. So if we look at this van disposal, if we find out there's a balancing charge, we can reduce the qualifying cost of the new van, the replacement van. So that's why we do it first. So van proceeds 4,700. So I'm going to do working for that. Okay, proceeds were 4,700, and then tax written down value. So originally cost 22,000. It was purchased in September 2010 and then sold in 16, so purchase year end September 10. So the van and we're doing the year end 2016. So you get capital allowances in the year of purchase, but not in the year of sales. So 2010 form, you would have got it in 2010, 11, 12, 13, 14, 15, 6 years. You know, and you can write it out if you want. 2010, 2011, 2012, 2013, 2014, and 2015, which 1, 2, 3, 4, 5, 6. Now, the reason to do it is because it's inclusive. So you could think, oh yeah, 2010, 2015, that's 5 years, but it's inclusive. So 10, 11, 1, 2, 3, 4, 5, 6. So 6 eighths written, 2 eighths left. So the tax written down value then is going to be 2 eighths by the original cost of, was it 22,000? 22,000. So it was worth 5,500. We only got 4,700 for it. So they're going to give us additional capital allowances. So we'll get a balancing of 800, and this will increase the 2016 wear and tear. Okay, so if this is a balancing charge, it will be different. So now we can do our normal working. 3 types of assets: equipment, van, and car, and we purchased equipment and van, and we sold a van. Okay, so we've only 3 kind of columns: equipment, van, car. The original qualifying cost: equipment 180, 22. Okay, and the car won't be 35. 180 and 22, they're the easy ones. The car, does it tell us what type of car it is? Oh yes, category C. It tells the date of purchase, the assets, car, category C. So tax reference material, our friend, category C, 24,000. And then we go plus additions. And they're all at cost. Disposals at cost, or additions. So our equipment, during the year we acquired a van, 28. So 50 and 28. Equipment 50,000 and 28,000. New van 50,000. And the van, a new van, a replacement van for the one that was sold, 28,000. Now, and then we sold a van. So we sold this van that we originally had. It tells us here, during the year they acquired the van. And what you put in there is the original cost of the van. So we take out the original cost. So that cancels out those 2. Now, if we worked out a balancing charge on this, if it was sold for more, say it was sold for 6,000, we'd have a 500 balancing charge. We'd reduce the cost of the replacement van by 500 for the balancing charge, but not in this instance because it's a balancing allowance. So there the way the wear and tear then is an eighth. So 2016, that divide 8, or that divided by 12.5%. So just whatever is in this column or in this row divided by 8 for a full year's wear and tear. And so the total wear and tear for the year are 35,250, which is the sum of those three. 35,250, and then we go plus the balancing allowance redisposal of van was €800. So the total capital allowances for 2016 is 36,050. And that just comes up here then into our working. And our case 1 profits now is 358,550. And from here, and I'm going to finish up here, but from here we come back to our trading profits and we say our trading profits are 358,550. There were no deposit interest. There was rental profits, so we'll have a working to do for that because they received rent of 120 and then they had some expenses, so we'll have to do that. But that's another, to finish that we might do in class. But it's the working out of this which is the new bit, the trickiest bit. So I hope that was useful. There's the calculation again. And we'll be going over it in class anyway.